Good morning from Los Angeles. It's 10 a.m. Pacific, 1 p.m. Eastern. Welcome to Power Hour, the usual Friday edition. We have a lot to talk. Q&A is going to be at the end. I'm going to go through my watch list. I think market's at a very, very pivotal point. I will talk about that as well. Before anything else, please go to I have a free newsletter that goes out. Please go sign up to my free newsletter. It's at www.sergioavadian.com. You'll see a subscribe. It's free. You'll get, it's not about rideshare, obviously. This is a different channel. And please sign up and you'll get free newsletters, current events, not too much politics, but once in a while I'll throw something in there, mostly about economics, mostly about, yes, Barcelona #1. But, hold your horses as far as questions are concerned. I'll answer those at the end of the episode. If you're missing this, obviously, please, if you haven't subscribed, subscribe. If you have not shared it, please share. I think I'm putting out really good information. Channel is growing. I broke 1,000 subscribers in 3 months, I think, which is pretty decent for YouTube land anyway. And then, put a thumbs up. Supposedly helps the algorithm. And leave comments. All these things supposedly help. Chris, that's what Chris tells me. So welcome to Power Hour. I'm going to get into the topics right away, but many of you probably have individual stock questions such as NVIDIA and what's happening there. I will go through my watch list. I will give you guys my opinion. It's not about, it's not about the frequency of your trading that you're doing. It's not about how you're making your calls, right? What kind of setups you're watching. It's about being patient. You got to be patient. Just like anything else in life. If you force it, you're going to get smashed. So with that said, I want to get into my first topic. My first topic, I've been talking about this for actually a month and a half or two now. That last week I talked about U.S. Possibly losing its reserve currency status. If that happens, watch out. I think it'll be horrible, but I don't think it will happen anytime soon, probably not in my lifetime. Although U.S. is wielding its sanction power through, forcing it basically because we have the world's reserve currency status, but then petrodollars went away after 50, 60 years. Now, obviously, the BRICS, as we know, have been working on their own SWIFT system for interbank exchanges or money transfers. The other thing now that is happening is that, look, we are supporting Ukraine, obviously, sending him, I don't know, a couple $100 billion so far. And we obviously, if we don't like a country like Russia, and if they don't stay in line, we just go slap sanctions on them. And our friends in Europe, obviously, always follow. And when you slap sanctions on a country, it debilitates them. It really just sucks the dollars out of their systems. And dollars are used for everything, right? Because of the world reserve currency status. It's used for trade, exporting, importing, all that stuff, right? And so what happens is that we cripple countries such as Russia that has invaded Ukraine, and we're backing Ukraine. Russia would have gone through Ukraine in a week if we weren't sending him a couple $100 billion and all the missiles and all the weapons. There is definitely a point to talk about world's reserve currency power being used during the sanctioning periods. And but these people are not stupid either on the other side. So the BRICS especially are trying to move away from the US dollar. And I've talked about it many times. There is a lot of content on the channel. You can go check it out. And so the first topic I'm going to talk about now, Russia, they have been truly crippled, right, with the sanctions, and then dollars are leaving the system. And Russia is launching a cryptocurrency exchange, at least trial for cross-border payments, because when you slap sanctions on somebody and take away the dollars from their systems, well, they have to still transact, right? How are they going to do that? Are they going to do it in rubles and Japanese yen or in Chinese yuan. They have to do something, right? There has to be some cross-border exchange, and they're going to try it now. I'm not saying this is going to be bullish for Bitcoin specifically or any other crypto, but this kind of proves that the sanctions are effective, and these countries are turning to different methods to survive. And in a move to circumvent Western restrictions, which is sanctions, the Russian government has announced plans to launch regulated trials of cryptocurrency exchanges for cross-border payments starting on September 1. I think this is something very important to note. Again, I'm not saying this is bullish or bearish for Bitcoin. I'll have actually a segment coming up shortly regarding Michael Saylor, the all-in Bitcoin gentleman at MicroStrategy. But so according to the sources familiar with the plan, Russia will utilize its national payment card system to facilitate the exchange of rubles into cryptocurrencies for international transactions. Will it work? Is the cryptocurrency, look, the Bitcoin system is safe. We know that. It's been kind of proven that proof of concept is there. But is it going to be enough? Because Russia is as the largest exporter of oil and natural gas around the globe. Is it going to be enough? Is it going to be able to sustain itself? These exchanges are very fragile. We know what happened with FTX. We know what happened with, a bunch of other exchanges. All those transactions going through these exchanges, are there going to be any shenanigans? I don't know. But, they are trying. And it goes to show that there is a move around the globe going away from US dollars as reserve currency. So the NPCS, which is their national payment card system, which currently handles ruble-denominated interbank settlements, will be adapted to support these crypto-based payment trials. And look, this is the natural progression of US dollar slowly losing its reserve currency status, and the upcoming trials in Russia are part of broader efforts by BRICS. As I said, last couple of months, I talked quite a bit about this, the BRICS, Brazil, Russia, India, China, and South Africa, to reduce the reliance on US dollar in international trade. Exactly what I've been talking about last couple of minutes, a process known as de-dollarization. I agree. Look, the dollar is the dollar, although it has been the reserve currency of the globe forever now. Slowly but surely, these countries are figuring out that collectively their economy, although it may not be as large as the U.S. economy, we do. Last week's video was really, really great. I think I urge all of you to go check it out. It talks about how we actually use the world's reserve currency as a hammer on these countries. Like we do it with Venezuela, we do it, and look what's happening. Half of Venezuela is in the U.S. now illegally, right? There are repercussions of what we're doing here. We can't just say we're the angels of the world and then we don't cripple these countries. Look what happened to Cuba, right? Those are facts. When we slap sanctions on these countries, these people, there is only 360 million people in the U.S. There's close to 8 billion people on the globe. 360 million people ruling the lives of what they do locally in their own neighborhoods, in their own states and cities and countries. I think it's a little bit over the top as far as I'm concerned. So, and these BRICS, Brazil, Russia, India, China, and South Africa are trying to figure out what to do, how to get away from the reliance on, on US dollar being the reserve currency. The BRICS alliance has been actively exploring alternative payment systems, including the potential use of cryptocurrencies, so to insulate their economies from American financial influence. And that's exactly what we do. We financially influence these countries. We slap the sanctions. We drain their systems out of dollars. Every exchange, every trade, every dollar's worth of trade is done by US dollars, obviously. And if you don't have access to US dollars, what are you going to do, right? And it's a tough situation for everybody involved, especially these countries. But we'll see. We'll see where it goes. But this is an interesting development. I'm going to follow up on this, obviously. Will it work? I'm not sure, because the amount of trade is trillions of dollars around the globe. Are these exchanges going to be able to handle the exchange from local currencies to cryptocurrencies, and then that has to be converted back again, right? Because once the payment is done back and forth between two countries, it has to be converted to local currency again. But again, something to keep an eye on, something to talk about at your dinner table tonight, possibly. So the next topic I'm going to talk about is the headline actually of today's show. What's the topic, right? What's the headline, or what's the title of today's show? Who needs lower interest rates the most? Who does, right? We all do, obviously. I mean, yesterday, I was looking at the Dollar General's earnings, okay? Stock topped at 250. Now, yesterday went down 30% more, down to 84. Dollar General has not been down to that level in 20 years. And during the conference call, they said, well, who shops at Dollar General? The average American, right? Not the billionaires, not the millionaires, but the average American. They said the average American is definitely suffering from the ill effects of the last 4 years of inflation. And who made that up, right? Who brought inflation upon us? We did. The federal government did, with borrowing and spending and too many dollars chasing too few goods. And if a Dollar General is saying that, right, I mean, are we going in a recession? I'm pretty sure we are. But I'll talk about the lower interest rates and its effects shortly. So who needs the lower interest rates? We do, right? We know what has happened to our mortgage rates. If you have an adjustable, we know what happened to our credit cards. We know what has happened to car loans, right? I mean, when interest rates were at zero, everything was fine. We could go borrow at 2, 3, 4%. What happened to credit card interest rates, right? Now, minimum credit card interest rates that I see out there, even if you have good credit and if you carry balances, 25%. Well, and on the back credit, it's up to 40, 50%, right? So that's crippling the average American. And Dollar General said it clearly, and stock, was down 39 points in a single day. It's crazy, right? So the average American is suffering. They definitely need the lower interest rates. But I have a bigger picture in mind here. We all need lower interest rates, obviously, right? So, but what do these banks do? What do these lenders do, right? They jack up the rates really fast, and then they never lower it, or they very, 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 very slowly lower it. Okay, so is the Fed going to lower interest rates? Absolutely. In September, there is one coming. And if you look at the charts, the dot plots, as they call it, interest rates actually, it looks like they're going to be cut 6 or 8 times between now and the end of 2025. Why does the Fed cut interest rates? Fed never cuts interest rates when the economy is booming, right? In fact, they raise interest rates when the economy is booming. So my point is, yes, the average American definitely needs lower interest rates, but I think the U.S. government the Fed needs lower interest rates more than anyone. So here's the shocking stat of the day. U.S. net interest payments on national debt hit $861 billion over the last 12 months. Okay, we're talking just the interest payment. As we know, I talk quite a bit about it, the deficits, the national deficit just hit 35 trillion. In another 100 days, it's going to hit 36 trillion. It goes up $1 trillion every 100 days. Well, that means, right, it's like an IOU. We issue IOUs called bonds, bills, notes. We sell it all over the world, and we finance our deficits, right, by increasing the federal deficit. Okay, so, well, there's an IOU. There's an interest rate attached to every IOU, okay? And we have to pay interest. Literally, we have to pay that. Just like you have a car loan, you pay the bank interest. Well, we have to pay our note holders interest. So just the interest on that 35 trillion hit 861 billion. Think about this. It's almost $1 trillion in interest we're paying. And how are we paying that? We're printing it and paying it. It's not like money is coming in, right? Our budgets are completely blown up. It's exploded. So interest costs have nearly doubled in the last 2 years. Exactly, because when we had zero interest rate policy for how long? 10, 14 years, 15 years? The government interest outlay wasn't that much. Yes, we still had the deficits. Yes, we had the IOUs, But the interest on those bonds, the coupon, as I call it, on those bonds was not that high. It was like 1%, 0.5%, 2% at max. Well, when the Fed raised the rates, right, to kill inflation, which was created by them and Washington, obviously, as monetary policy follows fiscal policy. We know that. So when the Fed raised those rates, well, not only your credit card rates or car loan rates went up, but the Fed's IOU rates have gone up because every day they issue hundreds of millions of dollars worth of bonds and notes because there are ones that are maturing. So on these new ones, for the buyers to buy it, they have to make it attractive. They have to give them a return. Well, now the federal government is paying 4 or 5% on those bonds and notes, right? Short-term bills are 4 or 5%. So our interest cost has gone up to 861 billion, and I'm sure it's going to break $1 trillion shortly. So this does not include 100 billion of Federal Reserve payments handed to banks as interest payments. How is that happening? Because the banks, pension plans, mutual funds, individuals, other countries, they buy these IOUs because we have the world's reserve currency status. We still are considered, our bonds and notes are considered the safest, instruments out there, right? Backed by the U.S. government, which is like, I don't know, backed by printing machines. But $1 trillion in interest could be used for some other good things in this country, right? I mean, we know where our infrastructure is. We know where our middle class is these days. But no, of course not. We just borrow and then we just put the money on fire in interest rate payments. So including those payments, effective interest costs over the last year hit, there you go, record $962 billion. Who needs lower interest rates the most? There you go. The U.S. government needs to lower interest rates more than anyone because these interest costs are not only our debt is going up every 100 days $1 trillion, and let's add 250 million on top of that trillion because we're paying all the all the interest to the bondholders and note holders around the globe and in the U.S. So yeah, we need lower interest rates, but U.S. government, the big brother, needs more than anybody, because if we keep the rates at 5% and all the bonds that are maturing that we issued over the last 10, 20 years, they're going to get slapped a new interest on it, or new coupon on it, which is the return for the buyer. That's going to be 4 or 5%, and we cannot change that. By the way, if the U.S. government issues a 20-year note or 20-year bond or a 10-year note or a 2-year note, whatever interest that comes out with stays until maturity. We can't just go in the middle and say, "Oh, let's change it because we're lowering our rates. Let's lower it." No, I bought the note or the bond with 5% interest. You pay me 5% interest for the next 20 years. Do you see what's happening here, right? So, the big brother needs lower interest rates more than me, more than you, because this will affect it. I mean, this is an anchor on the economy, $1 trillion in interest cost alone. So on the next topic, I'm going to talk about, one of my favorite economists, rest in peace, Milton Friedman. Milton Friedman, even 20 years ago, if you watch some of his interviews, he was brilliant talking about, inflation and how crippling it is to the average person. I think inflation to the average person is just literally another tax hike, right? And I mean, because our earnings or our jobs are not paying us 5, 6, 7, 8% more every single year. So I talked about this in the past. If you had $100, you're losing 5 to 7% of its value every single year. You can believe the government if you want. Oh, government says everything is fine. Inflation is 2.8%. Is it really? Is it really? I don't think it is. So Milton Friedman, this is a new article, but he had said this before. Milton Friedman warned bad effects come later, in quotes, when you print too much money, right? So I'm going to talk a little bit about what you can do to hedge yourself against inflation and what investment classes work well, what investment assets that you can buy that works well during inflationary times. And to combat inflation, obviously, the top, I'm going to talk about it at the end of the show. is gold, right? I mean, we know gold is a reasonably good inflation hedge. Another one is Bitcoin, right? Because Bitcoin is finite, right? And then there's 21 million of these things out there, and over 19 million have been mined already. It's finite. You can't create more Bitcoin like we create US dollars out of the blue constantly, right? So that's one asset. Real estate, obviously, is another hedge to inflation. Another one is stocks. Okay, look at the stock market. Actually, inflation is good for companies. Why is it good for companies? During inflationary periods, the companies can raise prices. Obviously, there's a certain amount of elasticity. They can't just double, triple every year. But what they do is they raise prices, and that goes directly to their bottom line as long as their supply chain is proper, right? And as we know, I talk about it. If you go to Costco 10 years ago versus Costco today, what is your $100 buying? Is it buying the same things? In fact, there was a fantastic little TikTok video I watched. There was this gentleman who 4 years ago at Walmart had ordered groceries online, right? And in a lot of these companies, Amazon, Walmart, Target, when you purchase something online, their systems keep what you purchased in a database. And when you visit the site again, it'll ask you, do you want to buy these again? Right? The first thing they ask you is that. And what this gentleman did is he said he bought like 46 items, which was all, his weekly budget for essentials. We're not talking, other things. We're talking essentials, right? So uh, he said he clicked the buy the same basket again. So 4 years ago at Walmart, he paid $143 for about 44 items, right? That include chips and his essentials, basically, toilet paper, whatever. And so he clicked it again, and he wasn't shocked. He even posted the receipts, the credit card receipts. 4 years later, the same basket of 43 items was over $400. Think about it. And our government says inflation is only what, 2%, 2.5%, 3%? Well, that looks like to me 300%. So the essentials, just like Dollar General said yesterday during their earnings conference call, people can't even afford basic essentials these days. And if you have some funds, and if you're creating a financial future, proper financial future for yourself, there are ways you can hedge inflation. And those are the asset classes, right? Commodities, okay, gold and Bitcoin and real estate for sure, because real estate, I mean, look what's happened to home prices in this country. Why is that? Home prices have literally doubled in this country in the last 20 years. Why is that? It's because of inflation. It's not because the materials they use, the replacement value has gone up, because all the materials they have used to build those homes have doubled as well. So, and home prices have doubled, rent prices have doubled. So you can hedge yourself against inflation and look at the S&P 500, the stocks, right? If your dollar cost average over the last 5, 8, 10 years, where's your money? It's incredible, right? Because inflation is good for individual stocks, and individual stocks comprise the stock market. So yeah, those are the things you can do to hedge yourself against inflation, or to protect yourself from the effects of inflation. And I want to read this little paragraph, his quote, Milton Friedman's quote: inflation is just like alcoholism. I completely agree. He famously stated, in both cases, when you start drinking and when you start printing too much money, the good effects come first, right? You take a couple of shots, you're feeling good, no pain. And then you take a few more shots. What happens the next morning, right? You open your eyes, the ceiling is falling, right? But this is amazing, right? This is a great analogy, actually. In both cases, you start drinking, or when you start printing too much money, the good effects come first. The bad effects only come later. 100% agree. That's why in both cases, there's a strong temptation to overdo it, to drink too much, or to print too much money. Friedman's analogy underscores a fundamental economic truth. While printing money can provide immediate relief, which we have done during the pandemic, about $8 trillion worth, expanded the Fed balance sheet, it also sows the seeds for future inflation. Exactly. This is from the old economics 101 books. And he said these things 20 years ago. They're 100% valid today. As prices soar and purchasing power diminishes, for sure, the once beneficial policies would reveal their hidden costs. Well, I couldn't have said it better myself. Rest in peace, Mr. Friedman. I think these are so valid. Certain things change, but certain things don't. But if you want to beat inflation, well, either you have to ask your boss to pay you more money every year, 5 to 8% more. Good luck with that. Number two, you have to invest. You have to invest in real estate. You have to invest in gold. You have to have a basket of investments that keep pace with inflation. So your $100 that you're holding in your hand is not losing value 6-7% every single year. So the next topic I'm going to talk about is, as we know, it's pretty well publicized with the Jackson Hole meeting last week, actually, where Chairman Powell, basically the head of the Federal Reserve, he basically said, we're going to start lowering interest rates. We're ready to lower interest rates. Everything is doing fine. Economy is still growing, but we don't want it to slow down too much. All that blah, 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 blah. That they're doing it because unemployment is actually skyrocketing. And, economy is slowing. Fed never cuts rates when the economy is doing well. That's a fact. But then this is an amazing chart that we can take a look at. So a lot of people think when the Fed cuts rates, things get better, specifically for stocks, because I'm a trader and maybe you're an investor or a trader yourself. So there is something called the Fed pivot. So Fed pivots between two, cues. Okay. One is called quantitative easing. It's called QE, which what we did for 15 years, and then inflation soared, right? And then we do something called QT. QT is quantitative tightening. So how do we loosen and how do we tighten? And that's called a pivot. So when you're pivoting from QE to QT, well, the way we do it is we lower rates, QE, we buy bonds, we flush the system with money, we print money, we increase the money supply, we do everything we can not so the economy lives. Well, that's what exactly we did, $8 trillion worth during the pandemic, okay? Because the economy came to a crashing halt, right? Okay, so that was QE, but QE has been going on for how long? Well, QE started actually with TARP in 2008 during the great financial crisis, okay? And QE lasted from 2008 all the way to 2022. That's 14 years of money pumping, money printing, increasing the money supply. Well, that's what happens, and then inflation got created. So inflation is a good thing, but certainly it's like the oil of this, engine. You need a little bit of it. You don't need you need 5 quarts of it. You don't need 50 quarts of it. Well, what happens if you put 50 quarts of oil in an engine? It'll blow up, just like it'll blow up if there was not enough oil in the engine. Okay. So, but of course, we always overshoot, like Milton Friedman said in the last segment. So now we're pivoting. The Fed is pivoting from QT, which they said they've been tightening, which they have, because they raised interest rates from 0 to 5%, right? That's tightening. That means sucking money out of the system. They also attempted to lower the Federal Reserve's balance sheet. It was at 9.5 trillion. They slowly weaned it off to 7.5 trillion. But when they do QE again, that's actually going to skyrocket back there. By the way, the Federal Reserve is not supposed to hold the balance sheet. It's not supposed to have assets on its balance sheet other than short-term transactional situations like overnight repos and bonds and notes. That's what they're there for. They're not there to hold assets, but then they are, because they rewrite the laws. When the 2008 financial crisis came, they rewrote the laws. Okay, fine. So here's the chart going back to 1960s, okay? Every time Federal Reserve raises rates, and there are all these arrows up top. Please pay attention to this. If you like, take a screenshot to study it, when you have more time. Because this is very important that you people understand this, which is because everybody's expectation is that if the Fed cuts rates, the stock market will do well. Initially, for a few months, it does. But this is an election year. The stock market's hanging in there because of the election year cycles. But look at these arrows, okay? So in the 60s, when the Fed cut the rates, meaning Fed pivoted from QT to QE. So the lower line in the chart is federal funds rate. Federal funds rate is what rules interest rates in the country. Okay, federal funds rate right now I think is 4.5 or 4.75, or it may be 5. But in September they're going to cut it either quarter or half, and they're going to do it again in December. They're going to do it again next year, up to 8 times by the end of 2025. So by the end of 2025, this Fed funds rate should be probably back to 2.5% from 5 or 4.5. So, but look at the correlation, and the one up top, the graph up top with the arrows, right, is the S&P 500 monthly index, the monthly performance. Okay, and on each arrow I put Fed pivot. Fed pivot meaning we're going from either QT to QE or from QE to QT. Well, right now we're in QT, right? Quantitative tightening, we tightened, meaning we raised the interest rates. And then there's lowering part of it, which is QE. Okay, so look at the first arrow. The Fed pivot happened in the 60s. They started cutting the Fed funds rate from about 8% down to about 3%. And the S&P 500 took a beating of 36% during that period. Now, you guys must understand this. All these times that the Fed has lowered rates, going back to the 60s, that's how many recessions we had. Okay? So if cutting rates coincides with a slowing economy or a recession, S&P 500 will eat it. No ifs and buts about it. But look at overall picture, right? The second time in the 70s, and I remember that clearly, when inflation soared, right? And what did they do? The Fed pivoted again to lower interest rates. And look at the market, S&P 500 index took 48% beating. These are massive numbers, by the way, because when an index goes down 48%, literally your stock is going to go down probably 80-85%, individual stocks. And then there was another pivot, smaller one, late 70s, which I remember. I was very young, but I was always into economics. I remember when gold hit 800 the first time, and Paul Volcker was the Federal Reserve chairman, he raised the rates to 20%. Look at that, right? That's 20%, people. Okay, so when the Fed raised the interest rates to kill inflation, right, what happened? The stock market took a 27% beating, but that's when things completely started to derail, right? And for years, I don't know, 3 decades, we had lower interest rates than average, but we have seen 20%. And look what the S&P 500 did from the late 70s, early 80s, all the way to the 2000s, right? And then everything was fine. Obviously, we went away from the gold standard. We were borrowing money, but our ROI on the borrowed money was 10-1. Economy was booming. Everything was fine. Reagan years, whatever you want to call it. Again, not politics. And then let's look at the next Fed pivot, right? The next Fed pivot came into the late 90s. And when the Fed funds rate was lowered from about 6% to close to 1.5 to 2%, S&P 500 declined 51%. The next one, the 2008 financial crisis, the Fed raised rates to slow the economy. They went into QT mode. And then obviously the housing crisis happened. And sure enough, Fed said, oh boy, we got to cut rates. And that's when we went to the ZIRP policy, zero interest rate policy. And here you go. What happened then? S&P 500 took a 58% beating. Okay. So now I have not put the arrow yet, because when they start cutting rates, I will put the arrow up top just about in September of this year, because we're going to the Fed pivot from QT to QE. And what is the result going to be? Look where the S&P 500 is. Is it going to eat it like last time on average 40 to 60%? I don't know. Time will tell, but that's why I have a negative bias, because when the Fed is cutting rates, the economy is not doing well. And if we go in a recession, the market is extremely overvalued. So to me, time will tell. I'll be alive. No rush to trade anything, but this is called the Fed pivot. This is what you should expect. This is really, really an important subject you guys should understand. So the next topic, here's my man. He used AI to do this. This is Michael Saylor. Michael Saylor is the CEO, founder, and chairman of MicroStrategy, the largest Bitcoin holder, corporate Bitcoin holder on the planet, to the tune of 265,000 Bitcoin, I think. As Bitcoin today is about 58,000, those holdings alone are worth 13 billion. But the way Michael Saylor is buying those Bitcoin is he's issuing less than 1% interest rate convertible bonds. Convertibles meaning you buy the bonds, but then you can convert into common shares of the company to buy Bitcoin. And he has done that continuously. He has borrowed over 2.5 billion or 3 billion so far. He's basically mortgaging his company to buy Bitcoin. He's the biggest believer in Bitcoin. You guys will have your own ideas about it. And he, superimposed or put himself in front of the big bull on Wall Street. I've taken pictures with that bull. It's right in front of the old New York Stock Exchange building. And he says he is more bullish than ever on Bitcoin. Obviously, he has to. What is he going to say? He's bearish. I mean, he holds 265,000 Bitcoin, and he thinks it's going to the millions, the Bitcoin is. Now, you could believe that. You cannot believe that. Do I like Bitcoin? I certainly do. Do I like it to his level? No. But then there are ways you can participate if you're a believer in Michael Saylor as a genius, okay? So, I mean, he's mortgaging his company to do this, right? I mean, think about it. So you got to be a believer. It's a one-way ticket. There is success or there is zero. It's, I mean, if you do believe it to that extent, yeah. So the way you can invest, you can 4 ways. Well, there are 2 ways in good, but 4 ways if you want to leverage it more than you want to do, like Michael Saylor does. So one way is IBIT. IBIT is the BlackRock Bitcoin ETF. It moves with the price of Bitcoin, dollar for dollar. Those are very popular, very low cost. The second way you can do it is by buying the physical individual Bitcoin on an exchange like Coinbase, and then if you're allowed, create a cold wallet for yourself and take ownership of the Bitcoin and put it in your cold wallet. That's what I do. Number three is they have now started introducing leveraged ETFs. Okay. So there is a leveraged ETF on the Bitcoin price alone. It's BITX. Okay. Boy, Ida, Tom, X-ray. That's a 2-for-1 leverage ETF. And sure enough, somebody thought about it. Now, MicroStrategy is an extremely volatile stock. It's about $135, $138 a share, right? And when Bitcoin moved from 20,000 to 70,000, MicroStrategy went from $20 to $200. Think about it, okay? So that's kind of moves we're talking about here. Nosebleed, right? And then what happened, right? Bitcoin corrected, MicroStrategy corrected. So it's about 135. Well, somebody in their wisdom, okay? Now there is a 1.75 leverage, as if MicroStrategy is not volatile enough. There's a 1.75 leveraged MicroStrategy. I'm not going to call it an ETF. I don't even know what it is. But the symbol for that one is, so the symbol for MicroStrategy is MSTR, Michael, Sam, Tom, Robert. The 1.75 leveraged MicroStrategy, I guess, tool is MSTX, Mary, Sam, Tom, X-ray. So there's 4 things you can do. 1, if you believe in Michael Saylor, if you believe Bitcoin is the savior of the globe because fiat currencies are trash, I to a point believe, that's why I have some Bitcoin, maybe I think everybody should have at least 5 to 10%, maybe not 10, but 5 to 8% of their total assets in Bitcoin. Like I suggest, it should be in gold as well. Both are inflation hedges. Fiat currencies are losing their value. We know what's happening around the globe with the dollar issues, right? De-dollarization, all that good stuff. So Bitcoin should be every part of a portfolio, and it has proven itself. My biggest concern on Bitcoin was government influence, right? Government one day is going to come and say, hey, this is a black market thing. A lot of drug deals are happening with Bitcoin. We're just going to disallow the whole thing. Well, not anymore. So that fear is gone. That's why we moved from 2,000 to 20,000 to 70,000, because now BlackRocks are in it. Okay, Fidelities are in it. They have all these ETFs. The public is able to participate in Bitcoin through these ETFs. Well, BlackRock is the government in the US, so I don't think the government is going to come and disallow Bitcoin. But so with those ETFs, money is pouring into these ETFs, and these ETFs have to buy it. So the biggest ETF is IBIT, I boy I Tom, and then you can actually do the actual Bitcoin itself and take custody of it. Number 3 is MicroStrategy, an absolute Bitcoin surrogate on steroids. And then there's leverage ETF, 2x leverage ETF called BITX, Boy Ida Tom X-ray. And as you know, like I said, as if MicroStrategy was not on steroids, there is 1.75 times steroids of MicroStrategy, and that's called MSTX. So pick your pain if you're bullish or bearish. Look, if you're bearish on Bitcoin, you can short these things because they're going to go to zero. And well, I'm not saying MicroStrategy is going to zero, because MicroStrategy is a company that produces other things, such as they're an IT company. So they do have some value, but pretty much all of it is tied up to Bitcoin now. The fortunes of MicroStrategy and Michael Saylor is tied up to Bitcoin. So I wish him the best, but I think, I don't know if I would mortgage my life to buy Bitcoin, but I think he's on the right path. So, and the next topic I want to talk about, and this is Bitcoin chart going back to its inception. Okay. Very few things have done this well, but then you have to have the stomach for volatility. Okay. This is as of like yesterday, and Bitcoin was at 59,000. I think it's lower, about 58,000 and change now. Look at the percentage return since its inception, people. Okay. And we're not going that far back, by the way. We're going about, 12 years ish. So what asset class, right? I mean, if you bought it at $1, let's say, that's where the numbers are. 12,970%. So as of today, it's probably 12,800%, because it's down about 1,000 probably. But so the volatility is there, right? The first time it went to 20,000, then it came all the way down to 3,000. I remember that. The second time it took off, went to 60,000, corrected all the way down to 30,000, back to 65,000, down to, I don't know, 20,000, 18,000. And then that was the last move where it took MicroStrategy to the stratosphere. Now, what is happening? So if I was looking at this as a chart, meaning just no idea what this is, don't even know it's Bitcoin, I would look at this as I have talked to you guys before, right? Pictures are worth 1,000 words. Either this is a massive top, because it's just going sideways now. It's been going sideways for 6-7 months now after it made the major move. Actually, it's in a trading range of 70,000 to about 53,000. Pretty big range, but still sideways is sideways. So there's two reasons. After a big move, the markets have to consolidate themselves. The gains, consolidate the gains. So it's going sideways. Okay, well, either this thing is going to break out above 70,000 and next stop is 120,000, or we're going to go back and revisit, probably I would say 38 to 40,000, right? So, but still over, since its inception, basically, what's up 13,000? I mean, probably Nvidia is probably up that much, but other than that, not too many asset classes. Gold definitely is not up that much. So if you're a believer in Bitcoin, maybe you should wait. If it breaks out, buy into strength and buy it at 70,000 on its way to 120. Or, if this is the top, we'll find out. There will be a breakdown or a breakout of this. There's no ifs and buts about it. It cannot go sideways forever as it has done in the past before. So patience is the virtue. Patience is key. Patience. So that's Bitcoin and MicroStrategy. The next one. A lot of people ask me this, and then they're shocked when I respond to them. This is simple math, people. This is your returns on an individual stock. Okay? All right. So, welcome to Math Class 101. If you buy a stock at 10, okay, and it goes down to 5, how much money have you lost? 50%, right? For you to break even, what does need to happen? Stock has to go back to 10. Well, so when you lose 50% on a stock, if the stock goes back, if the stock goes up that 50%, you are never going to break even. Stock has to go up 100% for you to break even. This is why I could not talk more about what? Risk management. Cut your losses short if you're trading, when you're trading, because you're against this. A lot of people think, yeah, I'll hold it. I'm like, okay, go ahead and hold it. But the numbers are so skewed, and the more you hold on to something and losing money on, the more that has to go back up for you just to break even. So here are the chart. If you lose 1%, goes up 1%, you're even. If you lose 5%, it has to go up 5%. Required gain is 5% to break even. At 10%, it has to go up 11% for you to break even. This is where the numbers get larger now. If you lose 20% on an equity or underlying asset, it could be option, equity, whatever, just numbers, right? You need 25% required gain to break even. If you're down 30%, you need 43% to break even. Look at these numbers now. If you're down 40%, you need 67% to break even. If you lose 50% or on unrealized loss of 50% on something, it has to go up 100% for you to break even. Think about this, okay? And just like I said, the stock goes from 10 to 5. You're still holding. Well, it has to go from 5 to 10. 5 to 10 is 5 plus 5 is 100%. So think risk management, people. If an equity or on any asset class goes down 60%, it has to go up 150% to get back to even. And if it goes down to 70%, down 70%, after you invest or buy, it has to go up 233% to come back to life, to come back above water. So please pass this around. This is math. Math don't lie. Math is black and white. And all I can tell you is that risk management is key. Don't let it get to these steep losses. 10% is manageable because it has to go back up 11% for a break even. 5 is manageable. So my number is 5 to 7 to 10%. If it gets there, I cut my losses short because I know what's coming. 20 is max because, okay, you can get back up to, to even with a 25% gain after a loss. But the rest is, you can't sustain this. This is unsustainable. And the last thing I'm going to say about this, people ask me, here's it's not a trick question. Most of you will get this. How many times can a stock or asset go down 50% and not hit zero? How many times? Most people say twice. 50% and 50% is zero. No, there is something called a decimal point. Something can go down 50% forever to eternity and still won't hit zero. Because after the decimal, the numbers will be like, hundreds of digits to the right. Okay. So think about this. Okay, people. So when you're trading, please manage your risk. Don't get into I bought it at 10. It's down to 3. No, it has to go up 233% for you to break even. Well, this is also opportunity cost, right? You're missing on things that could have made you 233% from the get-go. So that's that topic. Please, when I put this video out, please pass this around. Last topic I'm going to talk about today before I answer your questions and go to my charts is gold. What has gold done, right? Gold, look at gold, going back to 1990s, right? Wonderful, nice and steady. But the topic of this segment is going to be, if you had gold, if you invested in gold, should you sell it? Right? Because gold is also, it's volatile, not like Bitcoin, don't get me wrong, but it has its ups and downs, although it's mostly steady. But since 2008, what happened in 2008? Okay, in 2008, we printed for the great financial crisis, because you could just look at this chart actually and kind of feel what your pocketbook is feeling, with inflation involvement, right? So in 2008, when the massive QE came in and we cut the rates to zero and we kept it there, what did gold have done? Gold has done really well, right? It was $800, went to $1,800, and then had a correction back to 1,000, back to 2,000, back to 14, 15, it was 15, 1,600, and now it's taken off. We're at 25, 2,600. Why? Gold is a good inflation hedge. I mean, to a point, not as good as real estate probably, but gold is a good inflation hedge. But the way gold is attached, what is it attached to? Obviously, QE, QT, interest rates make a huge difference. That's why gold is a decent inflation hedge, and you should own all gold. But at this level, now you could be a buyer and holder forever, and you would have done really well. However, if you're a trader, would you sell gold now or would you buy gold? At the moment, what I would do is I would be a seller of gold. Why? I'll explain in a minute. And I mean, is it going to crash? No. Where is it going to go? Probably down to 2,000. And that's a $500 to $600 move. That's pretty big. But if you're a buyer or holder, hold gold forever. In my portfolio, I have 5 to 8% of it in gold. I've had it for a while. In my long-term investment portfolio, I will hold it. I will not trade it. But if you're a trader, right, I would sell gold at the moment. I'll give you a couple of reasons. One, we're cutting interest rates, okay? Why are we cutting interest rates? Economy is slowing down. Inflation is going to go down. And the effects of inflation on gold may not be as high as, the previous 3-4 years, right? That's one. Number two, when we cut interest rates, obviously lower interest rates are okay for gold, okay? But the other thing that it's going to do is that it's going to affect the U.S. dollar. The value of the U.S. dollar, there's something called the dollar index. Dollar index is comprised of 6 currencies: euro dollar 57.6%, Japanese yen 13.6%, sterling pound, the British pound 11.9%, Canadian dollar, Swedish krona, and Swiss franc. That's the basket that the dollar index is made of. And this is the dollar index going back, the same time period as gold, right? So as you guys can see, when the dollar index is going down, that means the US dollar is losing its value against other baskets of currencies. We need to be careful about this. And this is also part of what happened with the carry trade between us and Japan. So please just, hear me out for a minute. When we cut interest rates, when we raise interest rates, as you guys can see, it happened in 2021, the dollar gains value against other currencies. Every time we have raised rates, the dollar gains value. And when we start cutting rates, the dollar loses its value, right? And when the dollar loses its value, that means, we're cutting rates because inflation is slowing down. It may affect gold negatively to the downside. So bottom line is, would I buy gold today or would I sell gold today? Today, I'll be a seller of gold and waiting for maybe 22,000, 1,800 to 2,000 level to re-enter if you're a trader. But if you're a long-term holder, gold has been a wonderful asset for you. Since in 1996, gold price, or 2000 actually, let's go to 2000. In 2000, gold was about $300, okay? Today, $2,600. What is that? That's massive. That's over 10, it's about 10x, right? What asset class has done this well, other than obviously Bitcoin, at 12,000%, but 10x is, is awesome. And you would have protected yourself from inflation. So those are the topics. And the dollar index, I have an expectation of the dollar to go lower because we're going to cut interest rates. Although it may cut the carrying costs for U.S. gold, physical gold holders. By the way, you can buy and sell gold through an ETF called GLD, Gary, Larry, David. That's the way you can invest in gold. You don't have to buy the pound of gold or physical asset and put it in your safety deposit box. As we know, there's an ETF for everything these days. So, yeah, those are the topics. Let me see if I have any questions. Cheeky Chop spammed the board. Happy Friday. I don't think you guys have any questions today. Okay. Maybe I should change the time. How about Vix G says, how about BITO? Yeah, but I would go with IBIT. That's the largest one. Daniel has a good comment. He says, the only option the federal government has, well, buy back with what, Daniel? Print money and buy back? And then on one, it's like taking out of one pocket, putting it into the other pocket. Actually, the government has done that when they want to inject liquidity into the system, right? They have done that in 2008. They buy all these assets and they loan money to the banks, and they have done that in 2008, and they have done that during the corona crisis, obviously the pandemic. That's what they do. They buy bonds. They inject liquidity into the system. That's how they do it. But that's why their own balance sheet is at $8 trillion or $7.5 trillion. See what is happening there? Yeah. Rich says, yes, but real estate. Yeah, real estate is not a trading tool, Rich. I mean, you buy a multi-unit, you hold it. Price goes up, you're building equity while you have passive income. I didn't mean it as a trading tool to combat inflation, right? It's not. I didn't think so. That real estate is not an equity or an option. Here's another good question. Where do you think the 30-year mortgage interest rate will be just before the election? Just before the election, probably about 6.5. Because the Fed is going to cut either 25 or 50 basis points. As soon as they do, they drop the mortgages. The banks drop the mortgages. Probably 6.5, 6.25, 6.5. But then there are eight cuts coming. So, be patient. If you're going to buy a house, I mean, the affordability index is horrible right now, but major part of the affordability index on a real estate purchase is, your mortgage. So, I would wait about another year. And then your affordability index may be aligned with what's happening with interest rates. So if they cut it, look, even if they cut it a quarter of a point, 6-8 times, or maybe a couple of halves in there, if they lower the interest rates by 200 and, let's say 200 basis points, well, mortgages are right now going to go 30-year mortgages from 6.5, they're going to go to 4.5, 5. That's massive on your mortgage, right? So I'll answer questions later if you guys have it. So let me add my trading screen. So I am perfectly comfortable now with Thinkorswim. I have gotten used to the idiosyncrasies of the system. I'm trading now, actually. I mean, I'm not going to say I like it as much as what I had before, but I'm surviving. That's all I can say. And let me add it to the screen. I hope you guys can see it. Can you guys see it? All right. So, this is the S&P 500. Let's go to the charts. This is the S&P 500. Okay. This is what it has done. It took a huge dump from 560 to about 510, which is 10% in a matter of 3 weeks. And literally now it snapped right back up to the old high. And I'm circling this now. And literally it's going sideways, right? I mean, how many days of sideways action is that? 1, 2, 3, 4, 5, 6, almost 10 days now. Now, what will happen here, people? You guys should know that if you read your books and did your technical analysis, what's going to happen? Either we're going to have a rollover like this, when these lows are broken, it's still above its 20, 50, and 200, obviously, but when these lows are broken, there's going to be a rollover, probably another correction, or if we are able to break out, we're going to go to all-time highs. So again, 10 days of sideways, you could have traded your butt off and you would have probably lost money or the churn and burn. So be patient, please. Next one, I'm going to look at the usual triple Qs. Triple Qs is the NASDAQ 100, which NVIDIA is a huge part of. Triple Qs are more volatile than the S&P 500. What did they do? Triple Qs went from about 505, 503, down to 425. I mean, that's massive, right? That's 80%. That's 15% in a matter of 3 weeks, literally. Like 1, 2, 3, 3.5 weeks. This was during the carry trade debacle. I don't think the carry trade debacle is over. I think it's going to continue. I think the second unwind is about to come. But then we snap back violently, and now we're kind of lower to sideways on the NASDAQ 100 as well. Well, again, the same thing. Either we're going to roll over, go under the 20 and the 50, and the MACD is kind of rolling over, but MACD, I mean, there's a big move coming up, people. Okay, in the next 2 weeks, we're going to have a massive move coming up because the other thing that I watch for that is VIX, the volatility index. Remember VIX, people? They changed the symbol, I guess, on the volatility index. Oh, okay, it's just VIX now. In Schwab, you used to have a dollar sign. Look what happened to the volatility index. You went from 12, and this was when I was saying, watch out, people. Watch the volatility index. It went from 12 to 65, and the volatility got crushed. We're back to 15. When there's low volatility is inversely related to the stock market moves. So now we're at 15 and a half, still holding above 10, 12, because the average is about 10, 12, or not 10 that low, but about 12-ish. If we have another spike, that means the market has eaten it. Or if we stay here and go lower towards the 12 range, that means market's rallying. And let's look at NVIDIA. NVIDIA, everybody's darling NVIDIA. Let me get rid of this. Okay, so what has NVIDIA done? NVIDIA went from 140 down to 92, literally. I mean, that's 50 points, people. Okay. And then it snapped back to 130. Earnings came out yesterday. They were okay. I mean, they beat, obviously, but market's always looking 6 months ahead. And one bad thing that's happening at the old high, look at the MACD, non-confirming high on MACD right here. Okay. And then off to the races to the downside. Great trading opportunity here. When NVIDIA moves, it moves the triple Qs, because NVIDIA, by the way, is 8% of the S&P 500. I think 11% of the triple Qs. So NVIDIA is the king mover, obviously, here. So now MACD is kind of rolling over, and so is NVIDIA. With all the great earnings, why isn't it going up? Well, that means, is the AI boom over? Is that what we're watching here in real life? So NVIDIA is right on the 50-day moving average EMA. It's under its 200, above its 200, obviously, and under the 20. I don't like the chart. I think it's kind of a rolling over, but then I will love the chart if it goes over above 130, 131, and then clear breakout, and it's on its way to 150. FYI, every single analyst on the street after the earnings raised their estimates. Hey, you believe the analysts. But then one analyst you got to go up opposite is Jim Cramer. Another one, let's look at, Apple. Apple, same thing. 240 down to 195, right back to 230. As you guys can see, everything crashed and then snapped back. But then all my technical indicators are not at old highs. That's something I'm very cautious about. Actually, I'm going to go back to this screen. Can you guys see any of this? Because I don't know if you guys can. I hope you can. I'm hoping that you guys can. But then I'll get back and answer some more questions before I finish the live stream. Amazon, same thing. So in the Mag 7, Amazon is not doing well. Again, Amazon goes from 200 to 150. I mean, these are trillion-dollar companies, people. They're trading these things like pork bellies these days. And then snap back from 150 to 180. Now it's kind of going sideways. Microsoft underperforming, actually. As you guys can see, the strong ones like NVIDIA's, or I'm going to show you Meta, how strong they are. Even within the Mag 7, there is strong ones, outperforming ones, and underperforming ones. Microsoft topped about 470, literally hit like 390. I mean, we're talking 80, 90 points, which is a third of the value of the company. I mean, think about it, okay? And then now it bounced to 420, but then it's kind of rolling over again. A lot of the Mag 7 looks like it's rolling over to me. That's why my bias is negative. On the triple Qs. Let's look at Meta, how different that looks, right? Meta is Facebook. See what I mean? It corrected right back up. It's almost going to make new all-time highs, right? So in the Mag 7, Meta is the best looking one for my money, technically anyway. Do I think it's overvalued? Obviously it is. As far as I'm concerned, pretty much everything is. Let's look at, let's look at my watch list, and then I'll go through some ones that I think are valuable. Here's one that I've been talking about. I said on the breakout, watch it. It's Affirm. All right, people, right? Patience, 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 patience. Stock starts moving, goes above its 220-day average, goes above its 50-day average, goes above its 200-day average, which is my key, and then earnings come out. And I'm long Affirm. It's up again today. It was up 30% yesterday. I'm about to sell it, actually, because there's resistance up at about the 50 level, but I'll just take a little bit of a cut here. reduce exposure because my bias on the overall market is negative. So Affirm is one that you need to watch. What else? Alibaba, one of my favorites. I clicked on something. Oh, it gives me the trading tool. I didn't know that. Okay, cool. That's Alibaba. I've been talking about Alibaba in the mid 70s. Yeah, a little volatile, but stock is about 83, so long-term hold. So here are the ones that I was talking to you guys about. This is Bitcoin double ETF. Okay, so this moves twice as much as Bitcoin moves. This is the leverage ETF of Bitcoin. Here's one of my favorites, Kava. Look at that, right? I mean, beautiful chart. I ate there first time in the 30s, $30 right about here. And earnings came out, like absolutely pumped it to like 127. I mean, trend is your friend. So market could do whatever the heck it wants. If you're in a stock like Kava or Nvidia, what do you care? Market can do whatever. Markets, you don't own the market. You own individual issues, and hopefully they're good. And then here's the opposite of, here, I'm showing you this. I hate this company. I mean, the chart anyway, not the company. Look at this one. So see, same market, same S&P 500, same ETF. This is Celsius, okay? Stock is at 100, comes back down to 70, goes back, retests 100, and then it breaks down. Okay? Now, we're at 39, people. That's 60 points, right? Remember the numbers. So you're down 60%. You have to go up 180% to break even. See what I'm saying? Same market, same time frame. One stock is up 100% or up 60, 70 points like Kava is, which is right here. See, same market. If you own Kava, great. If you own Celsius or right here, if you own this one, where are you at? World of pain, right? So be careful with what you're buying. So pay attention to technicals. Another good one. There you go. What is this? Same market, Carvana. I've been talking about Carvana since I started the channel. Okay? Uptrend, pullbacks to 50-day are being held, which is the blue line that I'm highlighting. Keep it simple, stupid. This is not that difficult of a game. People asked me yesterday about GameStop. Actually, I'm long October $30 calls. I bought them at $1. They're like a lottery ticket. So if you guys are going to do anything with GameStop, I mean, look, there's not much volume, but I like to turn in MACD or MACD right here. This was the low. There is your MACD. This is a bullish divergence look, okay? If the volume kicks in, I'll make some money. I think I'm up there about 120, 125. So stock was up 10% yesterday. It's up another 8% today. It's at 23. Is it going to be the meme stock that it was? I'm like, no. Goldman Sachs. There's Goldman Sachs. Uptrend is uptrend, man. I don't know. There's Russell 2000, which I think, see, there you go. When they start cutting rates, I think Russell 2000 will do better than the S&P 500. So this is Michael Saylor's MicroStrategy. Here you go, people. If you have the stomach for it, see what happened to when Bitcoin went from, it was right here, 20,000 to 70,000. MicroStrategy goes from, this is a split price, by the way, 35 to 200. And then goes from 200 down to 100. That's 50%, people, losing 50% of this value. And then it goes back to 180, and then back to 120, back to 180. In the mini crash, we had back to 100. Now we're at like 130. But as you guys can see, it's kind of mirroring the price of Bitcoin, okay? And this is IBIT, which is the BlackRock Bitcoin ETF. It almost looks the same, identical, right? Except it's turbocharged. And now they have this thing I talked about called MSTX, which is 1.75 times MicroStrategy's price. So if MicroStrategy goes down 5%, this is going to go down 8%, right? And then when MicroStrategy goes up, same thing. So this has a high. It just came out, by the way, and money is pouring into this thing too. All the gamblers are into this. It went from 19 to 25. This is days, by the way. This is each single day. Another, I looked at NVIDIA. Palantir is everybody's favorite these days. Again, decent uptrend. You got to find uptrends, people. Don't worry about anything else. Roku, I started watching, is doing okay. It's kind of curling up though. It's about right about the 200-day moving average. It's on my watch list. I think you guys can definitely take a look at it. Shopify is another one. Again, you're trying to find outperforming stocks. Again, Sleep Number is definitely on my list. Actually, I'm long Sleep Number, about 13.5 range when it broke out. Now it's actually going above the 200-day. I'll probably add to my position. The symbol is SNBR, Sam, Nancy, Boy, Robert. And I love these types of sideways, setups that are about to break out. And Sleep Number, by the way. So let me put up the 3-year chart. Sleep Number, look where Sleep Number was. It was a $110 number. And then it came all the way down to 10, went sideways, literally for a year now. And now we're curling up, just about to break out. So I love these types of charts. These are my best setups, long-term, short-term. This is 1 year, 1 day. And let me show you disaster, right? Super microcomputers, right? Same thing. When NVIDIA was going up, they pumped this thing. These people supposedly do the AI servers. Stock goes from 300. They're about to split, by the way. Stock goes from 300 to 1200, and now we're back to the round tripper down to 435. Horrible looking chart. I wouldn't buy it with your money. Here's Tesla. I haven't looked at Tesla for a while. Yeah, Tesla kind of going sideways, biding its time. I do. If you guys watch me enough, I said I traded Tesla beautifully right here between 185 and 280, 270. On the crash, it got back down to 180, bounced to 220. It's kind of going sideways, nothing to do. Some of you may be interested in Uber. Let's see what Uber is looking like. Yeah, 55 to 75 almost, and now kind of going sideways. Looks like a rollover to me. I wouldn't buy Uber. A couple more on my watch list. Upstart, obviously, was one of my favorites. I gave this to you guys. Hopefully you listened. On the day of the earnings that came out, right about 30, 32, I bought the stock. I traded the options. Stock is 45 in a matter of 2 weeks. Where are you going to make 20%? More, 30%. Another one I'm watching now is Zillow. With lower interest rates, they may do well. And, it's already in the picture. On pullbacks, I'm a buyer of Zillow above 200, above 50, above 20. I'm a buyer of Zillow about 50 to 52. It hit as high as 58, so keep an eye on it. Again, Zillow going back. You guys got to look at the long-term charts as well once in a while. Let's look at the 3-year chart on Zillow. See where Zillow was? Zillow was about 104. Came all the way down to the 40s, going kind of sideways, kind of curling up. Resistance at 60, but there's room. Even when the market goes down, you can always find stocks that are outperforming. Next week, actually, I will show you guys what I use to find these outperforming stocks. It's about $30 a month, and well worth the money. I have two. I have stockcharts.com and IBD, Investor Business Daily. Investor Business Daily is expensive. It's about $130 or $149 a month, but I use it because I trade a lot and I need these outperforming stocks, so I don't have to do my own research, really. It just spits it out for me. Stockcharts.com is like a poor man's version of IBD, but still very, very valuable tool, and I think you can get it for $30. What else? That's about it. Let me go back to the main screen to see if you guys have any questions. Let me set my stuff up here. SPY. Okay, let me go back to the main screen. Let me see if you guys have questions. And if you don't, then we'll end it right about here. All righty. Okay, let's see. Real estate illiquid, I answered that. Where do you think 30-year mortgage? I answered that. Doses, Sergio, do you experience laggy, slow fills on Think or Swim? Look, all of them are going to have that. It also depends on your internet connection, though. That's a good question, actually. I have 50 up, 300 down, and I'm on a dedicated line. I'm not on Wi-Fi. So I'm on an Ethernet line, so I'm not really experiencing that much of a delay. Actually, I'm thinking, it may be as fast, or as I don't think it's as fast as my high frequency trading, but it's pretty fast. So it all depends on your internet, and if you're doing it on your cell phone, on a on their app or whatever, yeah, you may see some delays. That's why I suggest using. There's also slippage. I suggest using limit orders, instead of market orders. Market orders are dangerous, man. Let me see. Yeah, it's normal, and it's the same question. Technically, that's a good question. Rosie, what is the best Mag 7 looking forward at the moment? Definitely Meta. Technically. Fundamentals are a different story. Technically, definitely Meta is looking great. Netflix, definitely looking good. The rest are just kind of crashed and bounced back, not even halfway. Like Microsoft is acting poorly, Amazon is acting poorly. So technically Meta and Netflix. Very good question. Any foreign markets you're interested in investing? US is the best, the most liquid. Look, I have 10,000 stocks that I deal with in the US between New York Stock Exchange, NASDAQ, and Amex. Although most of it is NASDAQ, most of it is big caps. There's so much to do here. There is enough volatility that I really don't have a need. And you have to also understand, Rosie, that a lot of the companies that you're trading in the US are global companies, right? If you're trading Coca-Cola, if you're trading Netflix, if you're trading Meta, any of these tech companies, Nvidia, they're all global companies that have exposure to global economies. You know that, right? So to me, going specifically like trading Volkswagen in Germany, I'm like, no, I'd rather trade Tesla. You know what I'm saying? So, okay, as Vic says, can you move the volume and MACD together? You have to give me context on that. What do you mean? Can I move the volume and MACD together? I mean, you mean put it together? Yeah, you can. It's in the settings. If you're asking me about Thinkorswim, you taught me Thinkorswim, so I shouldn't know this. You should know this. Cheeky Chop says trade. Cheeky Chops, thanks for not spamming the board like you did before. Let me see what kind of spamming you did, Cheeky Chops. I'm going to block you. I'm a Zulu, Africana, ZA. What are you doing? Are you South African? Kremlin is no good. Okay. All right. Russia needs to blow up. Okay. All right. I don't know. It's just you're not making sense. I think AI party is over. AA. I think it's completely overhyped. No, not really. If you missed the boat, I think you need to be patient with the AI stocks now. I mean, look, the poster boy for AI is what? NVIDIA, right? Earnings were great, beat by 100%. Guidance was great. Why is the stock going down? Why did the stock go down 8 points yesterday? We have a saying in our markets, okay? Buy on rumor, sell on fact. NVIDIA was great for, I don't know, 2 years. Where were you then, right? No. Investing, different story. Will I buy NVIDIA at 100? Probably, but then I'm a technical trader. I look at my levels. Most of the time I get in and out. My big portfolio doesn't have, my long-term portfolio does not own AI stocks. No. I owned actually NVIDIA. I prematurely sold it, obviously, after a 4x. I'm like, that's enough. And then it goes up another 4x. I mean, but you make money, you pay your taxes, you move on. There's no reason to cry. So if there's no other questions, I'm going to end this here. Please subscribe and please share. Get me to 1,500 subs, hopefully by the end of the year. What else? That's it. You stay healthy. Have a great Labor Day. Is it Labor Day? Yeah, Labor Day. Labor Day weekend, long weekend, 3 days. I need the Monday off. Thank God. No market on Monday, so you guys know. You all stay healthy and be safe. And I will see you all next Friday.